MultiGreen, building attainable, sustainable, and tech-enabled multifamily real estate through impact investing.
Welcome to the MultiGreen podcast. I'm your host, Randy Norton, and today we'll be speaking with Professor Bruce Greenwald, the guru to Wall Street's gurus. Bruce is the Robert Heilbrunn Professor of Finance and Asset Management Emeritus at Columbia Business School and is the former academic director of the Heilbrunn Center for Graham and Dodd Investing. Bruce is one of the best professors in the world and one of the best professors I ever had. Bruce has inspired many books, one of which is mine. And today, you'll see why on this podcast. Enjoy our conversation. Bruce, thank you so much for being on this podcast today.
My pleasure.
It has been at least 6 or 7 years since we last spoke.
For me, that's very recent. I have students I haven't spoken to since 1991.
Well, I'm just glad that you responded to my email and your email address didn't change. I was just doing some research on you, and I love this part in your bio where it says that you have this economics background, which is obviously economics is the science of choice, but it says that you are an expert in productivity and the economics of information. What is the economics of information?
Traditional economics never worried about who knew what. Unknown was simply described as uncertainty. But it turns out who knows what is absolutely crucial. So I'll give you an example related to investing because this is an investing podcast, okay?
Okay.
So the managements of any firm really are much better informed about its present state and its future prospects than any outside investor. Okay? So if the management decides to sell you stock at the given market, the existing market price, do you want to buy it? I mean, if an informed seller is interested in selling at that price, you'd be a sucker to buy from them. And what that means is in practice, which is something people never really considered, but turns out to be overwhelmingly true, is it's incredibly hard to sell equity, new equity on public markets or seasoned equity on public markets. It's a literally tiny source of equity funding. Almost all of it comes either from institutions like venture capital firms or private equity firms, or much more from reinvested earnings and depreciation recovery. So that's an example of how thinking about the distribution of information, who knows what, fundamentally changes your view about how economies work. And so information economics is really about addressing precisely those issues.
Oh, I love that. I want to go back to your career at Columbia. I know that you are not there on a daily basis anymore, but we first met there in 2013 at the Columbia Business School, where you were teaching the value investing course. It was the best course I ever took in my life, hands down.
Glad to hear it.
What are you most proud of as you look back at your tenure as the Robert Heilbrunn Professor Emeritus of Finance and Asset Management and the academic director of the Heilbrunn Center for Graham and Dodd Investing?
Okay, it actually is only peripherally related to that. So the reason I decided not to become a traditional economist was that when you become a traditional economist, the students who matter are the PhD students. And two things occurred to me. One is they're incredibly dependent on you, and I didn't want people to be that dependent on me because I'm completely unreliable. And the second thing is the world really does not need more academic economists out there. So it seemed to me a waste of time to do that. And I looked around and I said, well, which students that are produced by universities have the biggest impact on the quality of human life in the world? And I think it's overwhelmingly the business students, because if economies run well, it completely changes the nature of human existence. I don't know if you know, I think I probably said this in class, but the most important fact about history you never learn in high school or any school. And it is simply this, that literally from Roman times, and probably before then, when we have the first good global data on standards of living, until sometime between 1800 and 1820, the average human standard of living does not change. That 90% plus of the human race eats only staples, They literally share space with their animals. When they live, they have one suit of clothes that comes off and on like animals molt fur in different seasons. Entertainment is sort of what God provides for the propagation of the species and getting drunk once a year. But it really is not very different from expensive livestock. So for all that period, the vast majority of the human race is expensive livestock. And then it changes in 1800. And it's not because of new discoveries, because the discoveries actually take place earlier in the 1700s. It's that those discoveries get put to work. It's simply the idea, and you sort of begin to see this in Adam Smith and his pin factory, that you shouldn't just find the best way to do things and do them that way forever, which is the classical idea. That every year you should do slightly better than the year before. And that idea, which gets implemented by business people and subsequently by professional managers, completely revolutionizes the quality of human life. So today, and I don't care where you live, 90% of the human race lives better than the kings and dukes did in that period before 1820. So I'm really proud of what my students have done. I mean, I think they've gone out, they've upheld a very important tradition of professional management. And you look around and they've done really good jobs. And the world is better for it.
Absolutely.
Thank God they're not lawyers or government officials, or God help us reporters.
I tell everybody every day that the world is getting better. And statistically, you can look at those facts. And I think this is a great example of that.
Oh, absolutely. Absolutely. And again, the people who are doing it are my students. I mean, imagine you can be a do-gooder and it doesn't really, I mean, governments really just, they don't produce things. They just take things from some people and give them to others. But if you opened an effective factory in Africa that employed 1,000 people, you would probably change dramatically for the better 5,000 to 10,000 lives. And nobody else has that kind of impact.
Oh, that's great perspective. At the end of the course, all of the students received your book, Value Investing, From Graham to Buffett and Beyond. And at the very end of the class, all of us wrote messages in it or to each other. But I came up to you and you signed my book. It's one of my prized possessions. And it says, "To Randy, who can't seem to get enough." And I also remember...
I think you sat in the course twice.
That's right. I also remember a key takeaway from the course being that, do not let possessions possess thee.
Absolutely.
And it really has been a fundamental, religion and perspective going forward. So that was a great book. I read it. I've read it multiple times. You've now just came out with the second edition. What is different between the first edition and the second?
Okay, so let me be absolutely frank. The first edition is not a great book. I mean, there are a lot of things that actually I learned from my students and practitioners over the 20 years since that first book was written. And I think what I've learned means that the first book was an embarrassment. We did not do a good job of valuing franchise companies. So if you look at the Intel example, or you look at the WD-40 example, the valuation work is pretty primitive. The discussion of the franchises and the durability and what they look like is not bad, although that's better in the Competition Demystified book. So that's the first thing. We learned a lot, and it seemed to me that sort of as my valedictory to the profession, I ought to try and get it down in some sort of permanent form. But the second thing that's really important is that the three basic tenets of value investing don't change. I mean, you want to look for opportunity where you're going to be more often than not on the right side of the trade. Because every time you buy something thinking it's going to do well, somebody else is inevitably selling it to you thinking it's going to be doing bad. And you want to be on the right side of that transaction. So you want to look for situations, and classically for value investors, this was looking at the ugly, disappointing, overlooked, and therefore really cheap stocks, not the glamorous stocks with a great future that people tended to overpay for. But, there are enough value investors out there in the world has changed, so that's no longer enough. But you do want to have a strategy for fishing where the fishes are, in a sense. The second thing I think that value investors do, and again, it's surprising that not all investors do this, is they basically know what they're paying for. They know the value of what they're paying for. And the third thing is that you have to be disciplined in not buying anything when there are no, bargains available. You have to wait patiently and do nothing until you see a price at which it makes sense to buy the value that you've calculated. Now, those three principles haven't changed, and they probably apply well beyond value investing. But the practice of how to apply them has changed a lot. And what's really changed more than anything else is, and I'll talk about why it's happened because that's economics, I think it'd be useful for people to know about, is that the vast majority of value these days is in franchise businesses. What it means is because growth doesn't have value in competitive businesses, growth only has value or sustainable value in franchise businesses. But that means that increasingly, understanding value means understanding growth. And value investors have never been comfortable doing that. And there have never been good models for how to do that well, as opposed to just joining the herd and buying Amazon and Netflix and the others, which is going to end badly at some point. So what this book is really about, most importantly, is the idea that we talked about in class, which is when you have to do difficult things like judge the value of growth, which is fairly far out into the future, you better be really well informed. And to be really well informed, you better be specialized. So the old search strategy of just looking for cheap, ugly, overlooked and avoiding the glamour stocks really doesn't work very well anymore. People more or less understand that. You have to be an expert, certainly in an industry, and you can be an expert in as many as 2 or 3 industries. Warren Buffett has managed 4, but also in a geography that is a particular country, a particular area of the world. And the more specialized you are, the better you're going to do. So, and I think this is an example from class. If I spend my whole life doing onshore South Texas Gulf Coast oil leases, and that's all I do, and you fly in from New York and buy an oil lease from me, who do you think made money on that transaction? And that's because it's a complicated business, and for complicated businesses, which is what value and growth is, you got to be a specialist. So that's the first lesson that we've really emphasized in this book. The second thing is that when you go to value growth, you better be sure that you're looking at a franchise company. And one of the things I think you want to talk about later is real estate is very rarely a franchise. Sometimes it's a rare asset, but there are no real barriers to entry into real estate. You can buy land, tear something down, and build something new. The technology is not denied to anybody. There are no customer captivity in that game because there are very infrequent transactions. And there are really actually very few significant economies of scale. So in competitive businesses, growth really is not going to do anything for you because the competition just eviscerates the value of the growth. And therefore, if you're going to invest in growth, which is increasingly important, you better be able to recognize a franchise business. And we spend a lot more time on that than we did in the first book. Second thing is you got to be able to say what it's worth. And there's a fundamental problem, which is that most of the value here is so far out into the future that it really is almost impossible to tell what the value is. So if you think about it in a traditional discounted cash flow, all the value is in the terminal value. And the terminal value is a terminal cash flow, which you may estimate reasonably accurately if you're doing, say, 3 years out, times a multiple. And the multiple is 1 over the difference, rather, between a cost of capital and a growth rate. Mm-hmm. Today, probably the cost of capital are maybe 7. The growth rates are likely to be 3. So you got 1 over 4%, which is 25 times that terminal cash flow. But suppose instead of being 7 and 3, it's 8 and 2. Well, that's 1 over 6%, and it's only, which is 16 times, not 25 times, and it's only a 1% error in either direction. If, in contrast, It's not below 6 and 2. So the cost of capital is 5 and the growth rate is 3. That's 1 over 2%, which is 50 times. So that multiple with 1% errors in the growth rate and the cost of capital in either direction could be off by a factor of 3, from 16 times to 50 times. And that is really a fundamental problem. So then the question is what growth is worth. And I think the answer, which we develop at great length in the book, and really the book is about, so if you look at the Intel examples and the WD-40 example, which we just redid, they're much more informative and they're much more useful. And it is this. Today's price, you can't calculate a value for a growing franchise. But what you can do is you can say, okay, if I buy it at today's price, what kind of a return am I going to earn? You can just start off with an estimate of earnings power. Look at what fraction of that earnings power you think on average in the future managements like the one that's likely to run this company are going to distribute, and say you're paying 12 times earnings, sustainable earnings, so that you got an 8% earnings return, and they're going to distribute half of it. Well, you're going to start with a cash return of 4%. And then you get the value of growth on top of that. And the growth fundamentally comes from two sources. One is organic changes in the economy. So if you benefit from barriers to entry, when you get more customers from population growth, or your customers have higher incomes and spend more, your profits go up, your sales go up. And in a competitive market, you just have entry, which would destroy the benefit of any higher prices or greater sales level. Whereas if you benefit from barriers to entry, that doesn't happen, and you get the value of organic growth in sales. The other element of organic growth is just that costs fall as technology progresses. So you've got organic growth in margins, and you can estimate those two things reasonably sensibly. Not for things like Tesla, which are nascent industries where nobody really knows where they're going. But if you've got stable franchises like Coca-Cola or like most of the service businesses that are out there, you can estimate what those growth rates in margins and growth rates in revenue based on recent history look like. And then you've got that 4% of your money, of your 8% earnings, that gets reinvested. What that's worth depends critically on how well management understands their competitive advantages and therefore where they should be invested. If they're relentlessly focused on organizational improvements, if they expand at the margins or within their existing markets where their economies of scale advantages carry over, then they could produce as much as $2 of value for every dollar reinvested. And that 4% that they retain is going to be worth 8%. On the other hand, if they buy unrelated companies at hugely excessive prices, which is what Intel has done, you may get 20% of the value of that retained 4%, which is only 0.8%. But that is a calculation you can do, and you can sort of fill in the blanks by looking pretty carefully at the behavior of the management you're saddled with today and other managements. So really what the book is about is understanding how to identify franchises, understanding the implications of franchises, which essentially is that organic growth and reinvestment related value creation from growth only exists for franchise businesses. And then calculating these returns. And there's another reason why the returns are really useful to calculate. Because once, say, I calculate a return of, say, 11% on an investment in a business at the current market price, say 5% of cash return and a 6% growth rate. I'm going to compare that to sort of the return on average equity investments. And today, that number in the US is probably around 5.5 to 6%. And I've got a margin of safety between the 11 and the 6 and 5%. Well, franchises don't last forever. And that 5% has got to cover the fade probability, whether it's a random arrival at some unspecified time in the future or just exponential decay in the franchise. And that's something you can calculate. So if you think this franchise has a half-life, that is, it's likely to be gone with 50% probability in 50 years, well, the rule of 72 says that's an annual fade rate of 72 divided by 50, which is 1.4%. So your margin of safety has to cover that 1.4%. And notice that all these calculations are linear in the percentages. So you can recognize that fade is there. You can start to think about what these fade rates are, and you can adjust for them when you invest in these growth businesses, which almost nobody does currently. So you have a history of people overpaying for the growth businesses. So that's what's in the book.
Well, thank you for that summary. I want to go over maybe two more topics while we have you. One is on equity bonds, and then the other is going to be on specialization.
Okay, so equity bonds, yes. I know nothing about.
Did you ever read the article that Warren Buffett wrote on the how inflation swindles the equity investor?
Yeah, and he was just wrong about that.
Oh, interesting.
In the short run, what happens with inflation is that company managements who have a huge impact on the performance of businesses and therefore on returns spend all their time trying to keep up with inflation because they got to adjust wages every year. They got to adjust prices every 3 months. And it's just really hard to do. And what you see when inflation takes over is that productivity growth and organizational improvement just goes away. And that's why when inflation starts off, what happens is that business performance deteriorates and equity investors suffer. But over time, when it stabilizes, they adapt to high levels of inflation, and that gets built into the value of the companies. And Buffett has actually recognized that in the long run, if the price level doubles, the value of the real assets associated with a business or the value of a real franchise is going to double right along with it.
Well, I appreciate that response. Let's go to specialization. In the book, you say that specialization is a representing element to a search and that it is the most likely thing to put investors on the right side of the trade. Can you opine on specialization?
Oh, it's absolutely essential. I mean, let's talk to the example we just did, and then we'll talk about real estate because I think that's really important. It's specialization. Again, what's a really specialized thing? I do an industry, which is onshore oil leases. I do it in a very particular region, which is South Texas Gulf Coast. And I'm an expert in that. And if I focus on that for many years, and I focus on that with most of my attention, I'm going to know what those things are worth. I'm going to know who the good drilling managers are. I'm going to know where the geology is best. I'm going to know where the regulation is. I'm going to know everything about those leases. And it changes over time because, of course, oil fields get depleted and new technologies for extraction come along. And so this is a moving target. And concentrating on it is going to enable you to track those movements. So again, suppose you come in as a generalist, you decide to buy an oil lease from me at a price that I specify. I mean, are you going to make money there?
No.
I mean, that is the basic paradigm of specialization, which is being geographically specialized and being industry specialized. Now, the downside to that is that there are going to be occasions where there's just nothing to do in your industry. And if you can't sit still and you want to still be employed, what you want to do then is to develop a second related specialty. And to give you an idea of what people are capable of, Warren Buffett basically has done well historically in 4 specialties. They are old media, consumer non-durables, insurance, and banking. And you look at his returns in other industries, airlines, and some of these other businesses that he's bought, they're nowhere near what the returns are in those core markets that he really understands. So even Warren Buffett has limitations and benefits from specialization, and he can handle 4 industries and probably a little stuff on the side. But most people, I think 3 is the best they can do. If you are interested in real estate, you don't go to a city you know nothing about and think you're going to make money in real estate. You need local partners. And the same applies, by the way, to venture capital. East Coast venture capitalists will not do a West Coast deal without a West Coast partner. So in these competitive industries, which is what real estate is and what venture capital starting up really is, it's crucial to be specialized geographically. And obviously, it's crucial to be specialized by industry, because if you do biotech, you're not going to be good at IT.
On a recent podcast with Tano, the Value Investing with Legends podcast, you discussed this idea of local monopolies and how value investors specializing in local monopolies with geographical focus are going to have outsized returns. Can you opine?
Yes. Remember I said that the global economy has changed in ways that mean that value investors have got to be able to look at growth in an intelligent way?
Yes.
There are two changes that have done that. The first is manufacturing markets are big global markets. But because manufacturing productivity is growing faster than the demand for manufactured goods, the labor costs are just disappearing from manufacturing, as they did from agriculture in the late 19th and first half of the 20th century. And labor costs are the heart of economic activity. So when that goes away, the importance of that sector really goes away. So manufacturing is disappearing, and what you're left with is services. And services are produced and consumed in much smaller local markets. Because, you do restaurant customers come to you locally. School students usually, except for the very high-end schools, come to you locally. Hospitals and doctors treat patients locally. Housing is provided locally. So you have got not big global markets now, but increasingly you've got geographically separated, much smaller markets. And small markets are your friend. It is possible to dominate small markets and get economies of scale if there are economies of scale in the business. And typically, what that means is, and I'm going to give a couple of examples to illustrate it, the level of market share that an entrant has to get to be viable, goes way up. So that if you look at global automobile markets, people can be viable at 1% share. Appliance markets are global, and you can be viable at 1% global share. And you're not going to keep anybody out at that level. If you think of cell phones, they are actually local markets. And if you look at the profitability of companies that have 10 to 12% shares just lose money. Companies that are 15 to 20% break even, companies that are above 20% make money. So really, to be viable, you've got to get to somewhere between 15 and 20%, and that's much harder to do than 2% or 1%. And that creates a much wider moat to protect those markets. And the second thing about services is there's continuous interaction, that you really deal with your customers with relatively high frequency, not like buying cars or something like that, which you do maybe once every 6 or 7 years. And that enhances customer captivity. As we move to services, the prevalence of these local markets that are dominated by single competitors who enjoy all the benefits of barriers to entry and being a franchise business is becoming much more and more common. And companies that don't understand it and don't have focused geographic strategies like Caterpillar are just not going to make the kind of money that companies like Deere, that concentrates in services, that is service support, software that's locally developed so that every seed is individually planted in the ground at exactly the right time for each variety of planting. Secondhand markets, because these machines and plastic last forever. And then financing, which depends if you're going to be successful at it, because the machines are so valuable, on local information. And Deere has had a very focused geographic strategy. They're in the middle of probably the worst depression in demand for agricultural equipment that we've ever seen, and they've done just fine. Because having a monopoly enables you to have pricing power even in those circumstances. Caterpillar, when things go bad for Deere, when demand falls, in the old days, they used to go into losses. Now, their profit margins, which are double what they were historically, fall in half, and they still make as much as they did in good times historically. For Caterpillar, that doesn't have a focused geographic strategy, that's all over the place, that doesn't concentrate on service support, they see a 10% decline in demand and they go from profit to loss. It's an extraordinary difference. So in this world, you have to concentrate on service-based franchises, and you have to think, therefore, about the value of growth. Now, technology is doing the same thing. If you look at the old technology companies, IBM is the classic example. IBM used to do everything. They used to provide the chips. They used to make the hardware. They made the operating systems. They made the database software. They made the application software. And they did the service support. You look at today, the way IT works, Intel makes the chips. Microsoft does the operating systems, and they've actually expanded to adjacent essential sort of business functions. Oracle does the databases and the applications of those databases, although some highly specialized companies like Salesforce have made inroads into that. Adobe does the fonts and the graphics. Facebook does the interaction. Google does only search. And modern technology enables you to put all that together. And what that means is that the evolution of technologically driven markets is towards niche markets, because the technology enables you to just put the systems together. It's these niche markets that therefore are sustainable as standalones. And they're smaller markets, and you'll notice they're all dominated by really profitable companies. So the trend in technology towards niche markets is the same as the trend in services towards geographically based niche markets. And that's just the future you're going to have to live with. Those trends are not going to change.
Excellent. So you were my inspiration to write this pending book, Applied Value Investing in Real Estate.
I think it's going to be a great book. I mean, I really do. You have lots of examples of specialization, both by categories of real estate, but most importantly by geography.
Well, I look forward to getting you the first transcript.
I look forward to it. I'm a glutton for punishment too.
It is so hard to write.
It is, but what you're doing is incredibly worthwhile. If you teach people to do real estate intelligently, especially in places like Europe and Asia where they're just not good at it, you will save businesses and individuals who work for those businesses a world of hurt.
Well, I want to be respectful of your time, and I want to ask you two final questions. In the spirit of MultiGreen, as this is the MultiGreen podcast, I want you to locate your green. So what are a few of your favorite green things?
I love the lockdown because I get to stay inside and I don't have to deal with anybody face to face or go out and breathe fresh air. So green is not what I do. I guess the greenest thing I do is that now that I'm in lockdown, I can wear my shirts for 3 days. So I save on the hot water to clean them. Okay, but I have very little to offer there that's useful for any other normal human being.
Do you think ESG is going to be the way of the future with some of these investments and strategies?
I got to tell you, and I really and it's good. That's a really good last question because it takes us back to the beginning of this conversation. Helping other human beings has overwhelmingly come from economic development. ESG, as I say, is opening an efficient business operation that doesn't have efficient business operations. And you will do more for poor people and developing people than anything else. And when it comes actually to the environment, I'll tell you a little secret. If we can't control population growth, we're not going to be able to control environmental degradation. And here's the secret. Everywhere in the world but Africa, fertility rates are essentially below replacement. So we are heading towards lower population, and that's going to alleviate most of the environmental issues.
You know that MultiGreen launched from Europe, and our goal is to build 40,000 attainable multifamily homes over the next 10 years. If you had one wish for me, what would it be?
My wish for you is that in that process, you develop local capacities to build efficient homes in these countries where you're going to build those homes for poor people. And you train some of them to actually persist and then replicate what you do over time. Housing is the single biggest consumer segment than it's a service segment. And if you can, in the process of producing housing, improve the provision of housing, construction, utilities, maintenance, all those things, you will fundamentally change economies for the better. And that's what I really hope you do. I hope it's not just a matter of building houses, it's a matter of building institutional competencies in the areas where you build those houses.
Bruce, thank you so much for your time today. I hope next time I'm in New York, we can get together.
Okay, but as I say, I love the lockdown and not having to do that. It's a good way to do it for me. Anyway, it's great to talk to you.
Cheers. Happy holidays.
Thank you for listening. Join us as we build 40,000 attainable, sustainable, and tech-enabled multifamily homes by 2030. And if you like the content you're hearing, hit the subscribe button. Follow us at Think MultiGreen and sign up to learn more at www.multi.green.